8 weeks before her year end, this client of ours was about to pay £8,000 more in tax than what she needed to. One number moved to the wrong side of a specific date. That was it. I'm Mustafa, I run an accountancy practice, and throughout the year I have this exact same conversation countless times. And it's not really a tax conversation, it's simply figuring out where this business of our clients actually wants to head. Where do they see themselves in the future? So in this video, I'm going to walk you through the exact conversation that we have. Business strategy first and the tax planning second. And what I'll do is use a fake client scenario just to help you picture the numbers a little bit more. And by the end of this video, you'll walk away with the exact full checklist that we use on all our clients. And what you can do while you're watching is just write down this list and mark off one by one which one you've actually done. Or if you've never had somebody actually go through anything, just mark down the things that you'd actually like to speak with someone about. So before any sort of tax planning, what we want to do is look at the business itself. So James, for example, runs a marketing agency. Year end is 31st of March. His profits went from £85,000 to £140,000 this year. That's a 65% increase. And on surface, seems like a brilliant year. But here's the problem though. Yes, his profit went up by 65%, but hours worked by his team almost went up by the exact same number. So before we touch a single tax figure, the real question is, did the business get more profitable or did it just get bigger? And those two aren't the same thing. So we go through 4 things first. Number 1 is pricing. James, we figured out, hasn't raised his prices in 2 years. So his costs were up about 15%. So his revenue grew, but his margin didn't. We found that he had a 20% offer, which brought in about 30k throughout the year. But many of those discounted clients actually left, they churned. So that doesn't necessarily mean growth. It just means discount. So what we found with staffing was that it was a flat profit per head. And then we had a discussion on his next year's plans. And the reason for that is simply, let's say James planning on taking on 2 more staff or move offices, for example. Or he wants to push a new service line. That changes how much cash he actually needs to stay in the business versus how much he can actually extract. And you can't plan dividends sensibly without knowing that. So this is what James was doing. He ran everything off his own spreadsheets. He updated it monthly or whenever he got around to doing it. Now the thing with this is, you're fine with doing that at 50k turnover. It's cool. But when you start making more money, when you start making more profits, for example, this guy making £140,000 now, you got VAT, you got payroll, multiple income streams, different staff. It all becomes a big risk. So now at this stage, the question isn't, is software any better? It's simply how much time are you losing doing that reconciliation, uploading all these invoices, tying off everything manually every single month, and what does that mistake cost you at your current size as well? And for James, the answer was pretty simple. He needed to move to zero ASAP. So now if you look at tax planning, right? So let's say James wanted to draw 70k in dividends plus his salary of £12,500 before year end. If he took that out in one go, the total would be about £82,570. Now that would mean 31,800 of those dividends will be pushed into the higher rate tax. Now instead of taking it out all in 1 year, having a huge tax bill, he could split that across 2 years. Let's say those dividends were split before 6th of April and then the half of it was split after. Each year sits entirely in the basic rate band for his specific scenario. So that means the tax is drastically reduced. Now in reality, the money is exactly the same. It's the same money, it's the same business, nothing's changed. All it was a timing difference. Now if we look at James's actual pension contributions and dividends, James had £20,000 of spare profit sitting in the company. Now he has 2 choices to do with that. He can either take it as a dividend, which is roughly about £5,500 lost to corporation tax first, and then his dividend tax on whatever's left. So his net pocket will be around about £9,500. Or he could have that company, his own company, pay straight £20,000 into his pension as an employer contribution. Now the benefit of this is that it's fully deductible against your corporation tax bill. There's no income tax, no national insurance to think about. That full 20k just lands straight into his pension pot. And that's £20,000 working for his retirement versus that £9,500 in his current account, probably rotting away to inflation. The honest trade-off with this, just to be totally transparent, is yes, the money is locked away until you hit that pension age. This isn't like a always do this sort of scenario. It's just to be able to know that this option exists and you need to decide deliberately. But it's something that most directors don't get shown. And now into the equipment and the annual investment allowance. So James was actually planning to buy £25,000 of equipment for his office in the next 6 weeks. He was going to buy this anyway. Now, the annual investment allowance actually lets a company deduct up to £1 million of qualifying equipment in a given tax year. And you can actually deduct that in full in the year that it's bought. Now, James's profits this year, they actually were between the £50,000 to £250,000 span, where the marginal corporation tax for him was at the high rate of over 25%. It was essentially £25,000 times by 26.5%. So a £6,625 difference in corporation tax purely from moving the purchase date a few weeks earlier. Still the same equipment, still the same business decision, just moved it into a different tax year. And you know what? James, he borrowed around £14,000 from his director's loan account in December and he completely forgot. Common thing, happens all the time. Now, the year end is 31st of March, which means the deadline to repay that is 1st of January. So if you miss that deadline of repayment, the company pays a massive charge on top. And that charge is on the outstanding director's loan balance. Currently, it works out to around about a third of whatever's outstanding. Now, what we did for him was we actually caught that in earlier on. We caught that in around November time when we did the accounts, and he was able to actually repay that well within that 9-month window. So he didn't have to pay a third of that over to HMRC. Yes, he would get it back, but it's just a headache and a faff to do. And then there's the smaller things that most directors miss. You got things like your trivial benefits. Each director of a company, by the way, gets up to £300 a year in small gifts. Now, the only caveat is it's got to be up to maximum of a £50 per gift. But as long as it meets that criteria, up to £300 a year. So for James, he and his wife, there was £600 there available, fully tax deductible. And if these guys took that £600 as a bonus instead, they would have paid higher rate taxes on that bonus, and almost half of it would have been gone to tax. Then you got the marriage allowance. Now, if your spouse isn't using their full personal allowance, £1,260 of their personal allowance can transfer across into yours, and that can save the higher rate earner up to £250 a year. It takes a couple of minutes to set up, takes a couple of minutes to do the admin, but look, you've got a quick couple of £100 back into your pocket. And then you've got the ISA allowance. Most people seem to completely ignore this. You've got £20,000 each tax year. It doesn't roll forward, you can't carry it back, nothing. You miss it, you don't use it, it's gone. This is the easiest allowance to miss just by accident. Now, none of this is aggressive tax planning. There's no set agenda, no set scheme here, there's no grey areas. It's simply just 6 things that we covered. Now, these are just 6 overall things that we look at. There's so much more depending on your specific business, depending on where you want to go in the next 5 years, and depending on what you're currently doing, we can completely tailor it to make sure that it suits your specific scenario. And that's what a lot of people don't get. You get generic advice off the internet and you seem to implement that and still feel like you're overpaying tax, feel like you're just stuck, feel like you've got no clue as to what's going on. So if you want this sort of thing run for your own numbers, the link is below. It's a completely free call. Just click the link and book in. And if not, take this checklist, run through it in your own company, go through it with your accountant, sit down, have a conversation. Either way, you've got the bones, you've got the structure here to actually go through and save yourself some serious money. So subscribe to this channel if you want to see another breakdown, or even if you want me to go further into this and see exactly what we do with our clients, because nobody on the internet really wants to put this stuff out there. But honestly, I really don't care.